Interest rates and interest rate markets are an important part of finance, not just because interest rates are the effective rent that we have to pay on bonds, but bonds themselves are an alternative to equities. So the higher the interest rate on bonds, the higher the expected or required rate of return to equities. But before we get into some of the details of interest rates and interest rate markets, let's take a look at some of the definitions. First off, when we describe an interest rate, sometimes we hear the term points used. If somebody says interest rates went up by 25 points, they don't mean that they went up by 25%, but 25 basis points. And there are 100 basis points in a percent, so a 25-point increase would be a 0.25% increase. Another term that we often use is the risk-free or riskless rate. And that's the often quoted rate provided by central banks, and we hear in the media when they say that the interest rate or the Bank of Canada rate was 25 basis points. They're essentially saying that is the risk-free rate of return on an overnight instrument, a very short-term government bond. Essentially, that provides the baseline or the foundation for all other interest rates, both the rates that are used by the Bank of Canada for 1-year, 3-year, 5-year, 30-year bonds, but also the rates that companies pay when they borrow money from the banks. The rate is described through the sale and purchase of Treasury bills, through the daily auctions of Treasury bills by the Bank of Canada, by the Federal Reserve in the United States, and by other central banks worldwide. Other rates may be different because of things like the maturity differential or the length of time until the other bond matures, and also because of the default risk or the possibility of default. And for that we have things like security risk premiums. Maturity differentials essentially tell us about the time structure or the term structure of interest rates. So the longer the term, the higher the expected interest rates normally. Essentially, this accounts for the relationship between time and the yield on bonds when everything else is equal. Risk premium is the spread differential, the credit spread, the yield differential that's associated with the particular financial instrument and the issuer's credit quality. So if you're a riskier company, then you can expect to pay higher interest rates for every term, every time within that term structure. Now, the term structure is often described by something called the yield curve. And when we talk about our yield curve, essentially, the yield curve relates time and the interest rate. So if we have the interest rate on this axis and time on that axis, if we go between a time of 0 today and perhaps 30 years in the long term, and we give each of these categories a name, like 1 month, 3 months, 1 year, 5 years, 10 years, 20 years, that the rate of interest that's quoted often, the risk-free rate for a government bond, that's quoted today would be something like 25 basis points. That's the interest rate for one of the banks who could borrow from the central bank, or the rate that is paid by the central bank on its treasury bills for an overnight investment. Put the money on deposit overnight, take it out in the morning. Very, very short-term investment. Because more things can happen over time, and because in general we expect interest rates to rise, for a longer-term investment would expect a higher rate of return. For each period, each bracket, or we like to say each bucket of time, we generally expect to receive a higher rate of return. And That's because, in general, people require additional reward for tying up their money for a longer period of time. So generally speaking, the yield curve is the line that connects all of these different investments. It generally will be upward sloping. It typically is steeper in the earlier part of the yield curve and flatter in the later part of the yield curve. So we expect a maturity premium for investing our money for a longer period of time. Now, the yield curve is largely defined by our expectations of the future. Things like inflation will be an important part of the definition of the yield curve, but also our expectations of things like growth in the economy and even the behavior of central banks. Essentially, central bankers like Canada's Stephen Poloz or in the United States, Jerome Powell, central bankers operate independently, typically, or we could say ideally, of politics. They're appointed to very long terms. Typically, their terms are not revocable by the politicians in power. And the reason for this is that their job is to manage the issuing of government securities in a way that maintains the integrity of the currency. Their principal job is to control inflation, although their activities may have effects on other things like growth in the economy. If they issue too much money too quickly, they're going to create inflation and destroy the value of the currency relative to other currencies. So the exchange rate falls, especially for a country like Canada. If they don't issue enough currency, then growth of businesses and growth of the economy is going to slow down, and that also has implications. So that's a secondary one after inflation, or at least that's one of the principles of central banking. Of course, we can see what happens when central bankers decide to produce a lot of money. And essentially they do this by selling additional government bonds and buying them back. In some economies where inflation has run rampant, we've seen things like, in Zimbabwe, annual inflation running into the thousands or hundreds of thousands of percent, and the printing press is working constantly to produce enough money just to allow people to do things like, buy a loaf of bread. And when you need 100 trillion Zim dollar note in order to buy something, you know that the central bankers haven't been doing their job. The yield curve is largely determined by the sale and purchase of government securities. If the government issues a lot of securities, then the interest rates fall, because certain type of institutions need to buy those securities in order to use them as collateral for other purchases. So if they reduce the supply of Treasury bills that are issued, then the bank rate's going to go up. They will announce target rates. And for example, in April of this year, central bankers in Canada, the United States, European central bankers responding to the pandemic that we're currently going through, announced cuts in interest rates to historically low levels, in Canada and the US case of 25 basis points. Now, that becomes a target which is managed through the ongoing sale and repurchase of those Treasury bills and Treasury bonds that are issued by the government. If we look at any point in time on one of our data sources like Bloomberg, you can see that the yield curve, and here across the bottom we have exactly that kind of scale from 3 months out to 30 years, we can see that the yield curve is actually drawn by connecting all of the different buckets or categories for interest-bearing instruments. Treasury bills in the short term, because they're sold at a discount, they don't have a coupon rate, and Treasury bonds, 1 year, 3 year, 5 years, and longer, which have got a stated coupon rate and are also sold at a premium or a discount. For each of those points on that curve, for let's say the 3-month bucket, we have got an ongoing test of supply and demand. If there's a lot of growth opportunities in the economy, investors are looking for loanable funds. So we have a demand curve for those loanable funds. If the interest rates are very low, the demand is going to be extremely high. So we'll end up someplace on the curve over here, with a very low cost of credit because money's cheap, and a very high demand for that credit. Balanced against that, we have the supply of loanable funds. If interest rates are low, people are not going to be very interested in investing. So at a very low interest rate, we might be over here. And clearly we don't have a clearing condition where supply and demand meet. In fact, we've got a substantial gap between supply and demand. So at this interest rate, the demand for loanable funds would be way over there, and the supply would be over here on the other side. Essentially what happens is that the price of credit for a 30-day loan would get bid up to the point where the effective rate of credit, or the interest rate for a particular period, so the 30-day rate would be at this point, and the amount of money that's in the economy would match that. Now, central banks, of course, intervene in this by providing additional loanable funds through their Treasury bill auctions and create a clearing condition, or help to create that clearing condition. And this happens for each category on that curve. And of course, because this is a market-based thing, these equilibria for each of these points on the line may be unstable. They're constantly moving. And so the yield curve will shift up and down, not just the entire curve, but points along the curve, depending on people's time preferences. So typically, interest rate yield curves are upward sloping because people have got a general expectation, even though they might be wrong on a day-to-day basis, in the long term, they have an expectation that the value of returns that they expect to receive should be positive. In the short term, they'd rather have cash than to have a promise of cash in the future. This is the old idea of, would you rather consume today or wait for a year and then consume? If we're talking about something like a holiday, sure, it'd be nice to have a holiday now, but would you rather have a slightly better one in a year's time? How much longer would you wait for that better holiday? And so that creates a kind of preference for time, or liquidity preference. In other words, if you want to have your money today, you can have it, but at a lower rate of return. There's also going to be different types of categories, natural players in each category. So investors who are putting aside corporate money that's going to be needed later in the year will typically only invest in a certain category or bucket. So, for example, a university treasurer who collects tuition fees in September and disperses them over the year will not be willing to tie up that money for more than a year, because the funds will be needed to pay university professors in each of the calendar months of the year. On the other hand, investors who are looking for long-term returns may not be willing to put their money into shorter investments because interest rates can change, and if interest rates fall, they'd be left out. There's a reinvestment risk for them. There's also an effect of inflation that we'll talk about next, and that's called the Fisher effect. And essentially that says that people expect the returns to include both a real rate of return and some kind of inflation. Our expectations, or our belief that inflation is going to exist, is really what counts. So if we think that inflation is going to be a positive number like 1 or 2%, we factor that into our interest rate costs. Of course, short-term effects are going to be much more volatile than the long-term. Long-term, perhaps we expect a stable rate of 2%, but at the moment, perhaps we could actually see negative inflation rates or possibly property deflation. So the real rate of interest is our principal concern, and that's the rate that needs to be offered in order to persuade individuals to put their money into the bank and leave it there for a period of months or weeks or years, depending on their time preferences, rather than to consume today. It's also described as the rate at which capital physically reproduces itself. In other words, this is the natural rate of growth in the economy. We describe rates as being real and nominal. Nominal is the rate that includes both the real rate and our expectation of inflation. So if we expect 2% inflation and we need a 5% real rate of return, 5% plus 2% gives us a nominal rate of 7%. Our market interest rates on risk-free debt are equivalent to the real rate plus our expectation of inflation. Not the actual inflation, but our belief in inflation. And that's what we describe as the Fisher hypothesis. The real rate is obtained by subtracting the expected inflation from our observed nominal rate. Now, the market interest rate is going to be a formula that's going to include things like the required rate of return in real terms, inflation, and a number of other factors. The yield that we observe for a particular bond, either a company bond, a government bond, any kind of an interest-bearing instrument, is going to depend on the following factors. The R-star factor is essentially the risk-free rate of return in real terms. IP is an inflation premium. DRP is the default risk premium, an extra payment that we require for investing in a riskier investment. So a very high-risk junk bond would have a very high default risk premium. An investment in a AAA-rated blue-chip company would require a lower default risk premium. If the bonds are very thinly traded, in other words, they've only issued a few hundred of these bonds and there are very few buyers and sellers, you might have to wait a week or a month in order to sell the bond or even wait for it to completely mature. There might also be a liquidity premium. And finally, we have a maturity risk premium. That's the rate at which we would, or the extra premium that we would earn in order for waiting in order to be reimbursed by the borrower. So a 5-year bond would have a higher maturity premium than a 1-year bond. So going over these one at a time, we know that the real risk-free rate of interest is the rate of return on a risk-free security with no inflation. The best way of estimating this, because inflation happens with time, is to take a look at a very short-term Government of Canada or U.S. government or other government Treasury bill in an inflation-free world. That number changes constantly. There's an auction process that happens in real time. So while we have a stated target of, say, 25 basis points at the moment, it might be 20 basis points or 30 basis points, depending on which point in the day we check. The inflation premium is based on the idea that we're not concerned about having money, but we're concerned about having the things that money buys. So having $1 million would be a wonderful thing, but if we have to wait a year in a high inflation economy and it'll cost us $1 million to buy a cup of coffee at Starbucks in a year's time, then the purchasing power disappearing will be an important part of our calculus when we're thinking about how much interest to charge. So the interest premium for a particular maturity is essentially approximated as the difference between the yield on a non-indexed security with exactly the same maturity minus the yield on a risk-free, default-free government bond. So that's going to be the inflation premium. The default risk premium is something that we're going to spend a fair amount of time today looking at. And essentially, it's because investors need to be compensated for the probability that either the interest and or the principal will not be repaid by the borrower by the due date and in the promised amount. The higher the default risk, the higher the bond's default risk premium. Essentially, government bonds, Government of Canada bonds, around the world, most government bonds are risk-free or default-free, but the default risk can be quite substantial for other kinds of bonds. In theory, a province of British Columbia or a city of Vancouver bond would be default-free because they are guaranteed by higher levels of government. But there are cases where states and cities, for example, the city of New York, the state of California, have defaulted on their debt in the past, and higher levels of government have not bailed them out. So typically only the sovereign, only the government is considered to be risk-free. Every other type of borrower has got some kind of default risk. Some of the things that affect default risk, different types of provisions that are in the bond contract. For example, if the bond itself is secured by some kind of an underlying asset, in the true historical sense, bonds always were secured by some kind of underlying asset, and debentures, not to be confused with dentures, those are false teeth. Debentures were generally unsecured. They're only secured by the credit of the issuer. So if General Motors issued a bond that was only secured by their province, that was considered to be a debenture. If the City of New York issues bonds that are secured by buildings that are put up, then that would be a bond or a mortgage bond. There are also different levels of seniority. The higher the seniority, the higher you are on a pecking order in case of failure. So the most senior bonds have the first claim against any assets in the case that the company becomes insolvent. There may also be guarantees that are provided by governments. For example, when we have organizations like the Canada Mortgage Housing Corporation, the CMHC, that is essentially a private organization, but it's guaranteed by government. So the riskiness of the organization is essentially the same risk as that of the government. We have the Export Development Corporation, or in the United States we have organizations like the Federal National Mortgage Association, Fannie Mae. We have Ginnie Mae that also provides bond support in the United States, or mortgage support in the United States. Sallie Mae that provides student loan support. So those are semi-government organizations with typically with full government guarantees. Something else that may reduce the default risk is a sinking fund. We mentioned the sinking fund earlier when we were introducing bonds, and because that means that the principal amount is going to decrease the closer you get to the maturity of the bond, the lower the risk of the bond. So as the sinking fund starts to work, the default risk is going to fall. Also, debt maturity is important. Some of the world's best companies, some AAA rated companies, have eventually defaulted. So the chances of them defaulting in 1 year would be very, very low. If you say, what's the chance that they're going to default in 30 years? Well, much higher. Companies that have disappeared, like, for example, Kodak or Union Carbide, essentially they would have been highly rated with A ratings, but over time their rating quality fell. So the longer the maturity, the greater the default risk premium. We can see an example of how bond rating works from these bond rating agencies and their published credit ratings. The three best known worldwide, certainly the best known in Canada, include Moody's, Standard & Poor's, and Dominion Bond Rating Service. If you have a AAA rating, and you can see the scales are comparable but a little bit different. If you have a AAA rating with Moody's, Standard & Poor's, Dominion, then you're the best quality of borrower. The chances of you defaulting are incredibly low, at least within the short time frame. AA, still exceptional. A, still exceptional. In fact, all of the bonds that are BBB rated and above, in Moody's case BAA, which we still describe as BBB rated, these are all considered to be investment grade. Anything below BBB is considered to be a lower grade. It's often called speculative grade. Sometimes it's called high yield. And a very derogatory term you'll never hear a bond salesman use is junk bonds. And that's because if you fall below a BBB into the BB category, certain types of institutions are legally not allowed to invest in those bonds because they're considered to be too risky. For example, pension funds are limited in the amount of below investment grade bonds that they can hold. Government agencies may not hold junk bonds. So if you fall into the B category or the C category, the return is going to be very high, but the risk is also going to be reasonably low. Now, having a good bond rating would be definitely good for the self-esteem of a CEO. And often we hear politicians announcing that our province, our country is still AAA rated. There's a price that comes with being a very high-rated agency or high-rated company, and that is that you have to maintain certain criteria, relatively low levels of borrowing, for example. And that may also come with a cost. You've seen that many very successful companies have over the years decided that it really isn't worth holding on to that AAA status if it's going to otherwise constrain the company. For example, some of the best-known AAA companies include companies like ExxonMobil, GE, Merck, Bristol-Myers, and so on. These companies gave up, essentially made a strategic decision, that it wasn't really worth hanging on to that AAA rating. ExxonMobil originally earned their AAA rating in 1949, and imagine being the manager in 2016, oversaw the decline of the company from AAA down to AA minus. The reason why they may have chose to do that is because they decided to use more debt and less equity in their business, perhaps borrowing more money and using that to maintain dividends or to repurchase some of their shares. So by reorganizing their business, they now have a lower credit rating, but effectively they also have a lower cost of capital. So more debt in the business lost them their rating, but it was a good thing to do for the business. General Electric has actually got some problems in their business, and changing the way that their financial services business works also cost them their AAA rating. You can see other companies like Frontier Communications apparently fell from a AAA to a junk bond, and that's partly because of increase in the debt in their capital structure. So AAA, of course, it would be wonderful to be rated very highly, but that's not the purpose of a business. The purpose of a business is to create wealth for shareholders. There are many factors that affect default risk and bond ratings. Among these, we have important financial metrics that are commonly used, but in every situation, there is a specialized and bespoke method for rating and analyzing company credit quality, company debt. We see this not just with bond ratings, but also if you're working in a bank and you're analyzing corporate credit applications. Some of the common factors include things like the debt ratio, the debt to equity or the debt to asset ratio. There's no single right number for this, but the important thing is that the company is able to sustain 1 or 2 years perhaps of losses and not lose all of the shareholders' money, so that there's an equity cushion there to protect the bond investors. This is partly measured through things like coverage ratios, including interest cover, debt cover, operating profit cover, and so on, even cash covers. Now, these are different ratios that are used and are applied in order to ensure that the company can perhaps have a loss of 1 or 2 times its interest and still not eat through the equity, the protection that it has available. We may also see things like current ratios, the solvency ratios that are used as a test of this. How much in the way of liquid asset has the firm got in order to cover its interest payments? Certain other factors may be important, including things like earning stability. If your company's earnings rise and fall dramatically, then it would not be unusual to see the company's ability to cover its interest falling below the one important factor of 1. Some industries are, by their nature, quite volatile. For example, airlines. If there's a small downturn in the economy, airlines stop flying so many business passengers, their profits fall or quickly become negative. And so for that reason, airlines are not readily able to sustain large amounts of debt. On the other hand, utility companies see very stable earnings. In a good year and a bad year, their income will only fall slightly, and so for that reason, they tend to be much more likely to be funded with debt. Regulators may be a factor as well. If you're in a highly regulated industry, the ability of a new competitor to enter and steal a lot of your business is going to be reduced. Banks, for example, borrow a lot. They're almost entirely funded by debt, by the money that is owed to depositors, for example. But they're in a highly regulated environment where the government essentially determines how much profit they can make. If there's a particularly important source of product liability, a product failure perhaps, a large lawsuit that's looming, those kind of things could also be a factor in the credit rating, and even the accounting policies of the company. If the company's financial accounts are considered to be highly credible, it's much more likely the company will have a high credit rating. You can see from this table, from our textbook, from Chapter 6, this comes from Moody's, and it's a general overview of how ratings factors might affect a company. Here we have 5 different rating factors that are published, and after 2008, rating agencies are under a lot of pressure to publish how they rate companies, and that's partly because all of the rating companies were embarrassed when very highly rated companies or financial instruments failed. Even though they had a high rating, they failed because the rating agencies appeared to have been biased in favor of those companies because they were earning a lot of money by doing the ratings. So now they publish their rating scales, and we'll look at a couple of examples, or at least one example, in a couple of minutes. In this case, the profit margin of the company is important. If you have a 21% or higher profit margin, then clearly you fit into this AAA category. That would be a very high rating factor for you. So if you had even 22% profit margin, you still have a AA. If you fall perhaps below 14%, then you're probably below investment grade. So the profit margin might be part of that. The interest cover, your EBIT over interest. If it's 18 times, then you're AAA, and if it's only 5 times, well, you're probably only a BBB. A different measure of interest cover, a cash interest cover, funds from operation plus interest expense divided by interest expense. There we've got 17 times gives you AAA, and about 6.6 times gives you a BBB. For every industry, though, we'd like to be able to make adaptations because industries operate differently. So this general form that's provided in the textbook, in reality, is actually much more specific when we look at the rating methodologies that are published by these companies. In our classes, we're going to take a look at specific industries and how the rating methodology works. So we're just going to introduce the idea here. But for example, if you take a look at the telecom industry, according to a specific report that was done for telecom companies, the rating scale for this industry is based on the following factors. Well, these factors and other ones. We have qualitative factors, but the quantitative factors that are included in the report include things like that debt to earnings ratio, cash flow to debt, or a debt cover ratio, retained cash flow to debt, slight variation of that. And then we have a couple of different measures of the interest cover. So these are given different weightings, and for different, our total weighting here is 9%, 7%, plus 10%, plus another 21%. So we get about 47% of the total rating factors that are used come from these financial statistics. And if you've done very well in all of these and you have AAA for each of these things, then it's most likely that the overall rating for your company is AAA. If you have on the low side, then you are probably a B or a C. So this is essentially how Moody's does the ratings. And we'll go through that more in class in more detail. You can actually see the effect on certain companies. When we look at the back of the report, you can see that different companies were given different scores. Just to pick one here and take a bit of a look at it. if I'm looking at something called Telecom SA, about halfway down the list, or 2/3 of the way down the list, they have an overall rating of triple B, BAA, and then the 2 is on a scale of 1 to 4, so they're with a moderate outlook. According to the current evaluation, they should have a triple B3 rating, which is a little bit below that. And so it looks like they could actually be downgraded, possibly. The factors that affect them include things like scale. So on terms of the overall size and billions of dollars of sales, they're actually only a double B. They're a little bit below their average rating. In terms of their business model, they're rated triple B, which is right on track with their overall rating. Same thing with their regulatory and political position. When it comes to market share, they rate triple A. Now, I presume this is talking about a South African telecommunications company who probably have a very large share of the local market. So because they're at least 2 rating bands above their indicated level, triple B, triple A certainly is, that's why they're shaded green. They're a little bit low on financial policy. They're right on track for EBITDA margin. They're a little bit higher on debt to EBITDA. And they're a little bit ahead when it comes to free cash flow to debt. In fact, they're 2 rating bands, so they score a green for that one. Where they're low, the things that bring them down, and their retained cash flow to debt. So their ability to cover their debt with their retained cash flow. The cash flow after making certain distributions. So that's a concern to us. It's red. It means that there's a problem here. Same thing with the cash cover. The funds from operation plus interest expense divided by interest expense. That one is also a problem. So the 2 factors that I would be concerned about looking at this one company are those 2 triple C ratings that are shaded red. The things that are good, that mean that they could get upgraded, are things like their market share and their debt cover. So this particular approach allows us to do a couple of things. Number one, we can see predictions of what's going to happen in the future to that credit rating. But number 2, we can also see the factors that make them weaker or stronger. If I'm doing an evaluation of a company like this, then I would probably spend more time looking at the weak factors, because credit rating isn't about worrying about good things happening. It's about worrying about bad things happening. And the reasons why a company could fail or why a bond could be downgraded, pay a higher default risk premium, because of these red factors. Yeah. You can see an example of how bond ratings have worked. This is a rather old example, but still valid. We can see that on the day that this particular table was produced in a magazine called Canadian Fixed Income, the Government of Canada rate, essentially the risk-free rate on 5-year government bonds, was 3.01%, or 301 basis points. So the best rated instruments were Canada Savings Bonds, guaranteed by the government, also at the risk-free rate, so they would pay out 301 basis point yield. The best rated company on this list is the Bank of Montreal, BOM, and for a AA rated company, Bank of Montreal promises a yield of 4.68%. That's about 167 basis points better than the risk-free rate. So if you take 4.68 minus 3.01, you get 1.67, or 167 basis points. That's called the credit spread. That's the default risk premium. And so the difference between AAA and AA, in this case, 167 basis points. If you're a company like TELUS, which has got a single A credit rating, the yield on this one is 488 basis points, or 4.88%. That's 187 basis points. And so for falling one rating band, TELUS ends up paying about 20 basis points more than it would if it was AA rated. At the bottom of our list, just jumping down to Shared International, we have a company which has got a relatively low credit rating. It's a well-run, well-managed company, but it has got a lot of political risk involved with its business. It mines things like nickel and copper. It also does oil exploration, but it does a lot of this in the Caribbean, in places like Cuba. And because it's under constant risk of U.S. government policy, Sherritt gets a low credit rating. With a double B rating, they're below investment grade, and so they have to pay a higher rate of return, at 7.47 yield on their bonds. That's 4.46% higher than the risk-free rate, or 446 basis point spread in 2008. And I should say that's at the beginning of 2008, before we have a financial collapse. If you did some more research, you could find out that companies like Dominion Bond Rating Service, and this is a much more current report, constantly reviews companies like this, and they either downgrade, upgrade, or they decide to maintain a current credit rating. In this case, they've said for Sherritt International, they're going to confirm their rating at single B, and for their senior unsecured debt, the debenture at B, but also at a low rating. So this is a very low B rating for the company, with stable trend. So essentially, yeah, we can see that there are problems with a company like this, problems with an investment. You're taking a higher risk, and that risk is largely because of things like, well, the market risk with the commodities that they produce, and also the political risk with the environments that they operate in. So that's a little bit about default risk, and we'll talk a little bit more about that in a little while, but let's jump ahead to liquidity premium. Essentially, an asset's liquid if you can convert it into cash quickly and get full price when you do that. If you have a very specialized asset, it might be quite valuable, but sometimes it's hard to find a buyer. If you're trying to sell the Mona Lisa, well, that painting was actually stolen, one of the most valuable assets in the world, but the person who stole it couldn't actually find a buyer, and so eventually it was returned to the museum, going back, I don't know, 70, 80 years ago. So having something that's valuable does not necessarily translate into cash, and that's really what's most important for us here. So liquidity or marketability essentially says that, or reminds us that some financial assets are much more liquid than real assets, but not always. It's often often difficult to accurately measure the liquidity of certain assets because we don't have a day-to-day quotation on a selling price. Liquidity premium, credit spreads, or the bond spreads, and the liquidity premium are essentially the difference between the corporate yield and the Government of Canada yield for the same maturity. So we do end up combining those things together. If we say that for all of our bonds we have a set default risk premium, for certain bonds that spread is going to be a little bit greater because of marketability issues. Bonds for large, strong companies often have very small liquidity premiums because their bonds trade frequently. And for small companies, they may have as much as a 2% additional liquidity premium on top of the default risk premium. Maturity is important, so all bonds, including Government of Canada bonds, have got two extra risks: the interest rate risk and the price risk. The longer you hold on to an asset, the more things that the government can do to change the value of that. If we have a change in policy and interest rates change, and you're earning a certain coupon rate, that could affect the overall value of your asset. Second problem that you have is if the asset matures, if it's going to be repaid, now you have got cash, and you want to guarantee that you can be able to reinvest in an equally valuable investment. That's called reinvestment risk. The market risk premium is the net effect of those two sources of risk on the bond yield. Essentially, reinvestment risk is important because it's the risk that the cash flows that we're going to get from interest payments and eventually from the principal repayment would have to be reinvested at a lower rate. For example, if you had invested 5 years ago and were earning a 3% rate of return from a guaranteed investment certificate, today you received the cash back and you're looking for another 3-year or 5-year investment, but you find that interest rates are much lower because of the current pandemic conditions, and you can only get 1.25%. There's almost a 2% decrease in your return on the reinvestment, so that's a significant risk, a significant downside to being able to cash in. Or let's say you won the lottery and you got $500,000. You invest the money and live off the interest. You buy a 1-year bond with a yield of 10%. You get used to earning $50,000 a year. At the year end, you get back your $500,000 to reinvest. But if interest rates have fallen now to 3%, your income drops from $50,000 to 3% of 50,000. 3% of 500,000 to 15,000, and so if you bought 30-year bonds, your income would have still been 50,000 a year. So by going short term, you have that additional reinvestment risk. Some other things to remember about the market risk premium: long-term bonds have a high interest rate risk and low reinvestment rate risk. Short-term bonds have a low interest rate risk because the interest rate reprices constantly, but they have a high reinvestment rate risk. So you have one type of risk or the other. The yields on longer term bonds are usually greater than those on shorter term bonds, so the market risk premium is much more affected by short term and unexpected movements in interest rates than by the reinvestment rate risk. The time structure and the yield curve is also significant. Term structure of interest rates, essentially as we saw with the yield curve, that's the relationship between the interest rate or yield and maturity. Typically it's upward sloping, and earlier on we saw that graph, the one that I drew of the term structure, and that's called the yield curve. Essentially the corporate yield curves operate parallel to those of the Government of Canada's yield curves. So if we saw that, and I'll just scribble something into the margins here. If we saw that the yield curve for a Government of Canada bond looks something like this, typically the yield curve for a riskier corporate bond would be a little bit greater at every point in the term structure. So the rate of return, the interest rate for our say our AA rated bond would be higher than for the government bond. They're not necessarily parallel. They may vary across time, especially depending on the difference in the risk and things like reinvestment risk. And yeah, typically also the spread is going to widen over time because of the increased uncertainty of the default risk for that particular class of company. You can kind of see how this works over time. Across the bottom axis here we have years. So if we're taking a look at the historical information about Moody's high-grade bonds, and here we're talking about double A's, single A's, and triple B's, all investment grade. As we're moving through the decade from 2003 to 2008, the typical credit spread, the difference between the risk-free rate and the rate on that class of bonds, would be something like 100 to 150 basis points up to 2007. If you take a look at the double A, or the green line, by the time we get to 2008, 2009, all kinds of interesting things are happening. So for example, in 2009, those double A rated bonds are going to have to pay a higher credit spread because we're going through a financial crisis. Also, the risk-free rate is falling, and the price of bonds is going down, pushing the yield on those bonds up. So they go up from about 100 basis points to about 300 basis points in the worst point of that financial collapse. But take a look at what happens to the triple Bs. They go up from about 150 basis points to close to 700 basis point credit spread. So when things get rough, the lower grade bonds require much higher yield. Their price falls, pushing their yield higher. That's because when people get nervous, they sell their riskier investments and they use the proceeds to buy safer investments, put their money into government bonds or into triple A-rated bonds. So that flight to quality is essentially what we're seeing happening here. So the credit spread becomes much greater over time for the riskier instruments. It's even more interesting if we look at junk bonds. And remember I mentioned junk bonds, the term that nobody in the business likes to use. That's because they'd rather talk about high yield. Essentially, high yield bonds give us much higher rate of return. Or speculative grade, because we're taking a risk. These bonds could improve with time, the companies could become stronger. Perhaps they're used to back investments, which may produce very high returns in the future. So they produce higher rate of yield and greater possibility perhaps for price appreciation. Essentially, these are the non-investment grades, double B or lower, according to Standard & Poor's, Moody's, and BA for the Moody's ratings. And essentially they're risky because the chance of default is considered to be higher. You can see from the experience of those bonds over that period exactly what's promised. The double B rated bonds, as we go from 2007, where they're trading at about 200 basis points, by the time we get to the worst of the financial crisis in 2009, the price on the double B rated bonds has fallen so much it's pushed the yield up to over 1,000 basis points. Now, that's bad, but it's far worse for those C-rated bonds. Triple C-rated bonds would see a rise in the effective yield to 20% higher than the risk-free rate. So if the risk-free rate was 2%, then the yield that was paid to those bonds would be 22%. Of course, yield doesn't change by itself. We see the price of the bonds falling because people are all trying to sell their C-rated bonds and buy A-rated bonds with the proceeds. And so that pushes the price way down and the yield way up. All of this is about the probability or the possibility of default. And one of the things that drives the rating services are the probabilities of default. And we call these the default rate tables, or the transition tables, and it tells us what's the possibility of a bond changing from one position to another over a period of time. So if you were at the beginning of the year a AAA rated company, the chances of, according to Moody's, of a corporate bond falling from one ratings category to another within one period, it would be 0.52%, very small. The chance of actually failing, 0.52%. If you're a triple C rated company, a CAA company, the chances of you failing within 1 year, about 69%. So essentially this tells us what's the probability of an outright loss as a result of our investments. And that takes us on to our final and probably least happy category, insolvency and bankruptcy. Essentially, we use a couple of standard terms for bankruptcy. We talk about things like receivership, insolvency, bankruptcy. The term bankruptcy itself is a kind of a historical artifact from the days of ancient Rome, when there was a huge amount of disgrace that came with bankruptcy. If you went bankrupt, you didn't just lose your business, you essentially lost your life. Your assets would all be sold. You could even be sold into slavery. And a bank that went into a bankruptcy was signified as having failed because its bench was broken. And the term bankruptcy comes from the term broken bench. This was not an effective way to manage insolvency, because the person who failed in business would never again become a productive part of society, and assets that might have otherwise been effectively redeployed to help to create wealth in the economy were no longer available. And so eventually we discovered that it would be a good idea to allow the orderly exit from business and the reapplication of those assets, both the physical capital, the plant, the machinery, the buildings, but also the human capital. The workers for the bankrupt firm could be redeployed into redeployed more effectively into another growing firm. And even the managers who'd been part of a bankrupt firm and the owners could find their way after a period of time back into business, having kind of sat on the bench for a certain period of time. That's why we created systems like in the United States, Chapter 11. In Canada, we have the Corporate Creditors Arrangement Act. And so those are essentially a type of reorganization. So in Canada, we have those two main types or main forms of bankruptcy. We have bankruptcy and insolvency for a completely failed business to redistribute the assets of the business through the creditors. And then we have the Companies Creditor Arrangement Act to reorganize businesses. An interesting example of this, you may still see the big empty building in one of the malls in Nanaimo for the Sears Canada building. Big red brick part of one of the shopping centers. That was until recently a major department store chain that went into insolvency. And after a period of insolvency, it was liquidated. You could take a look on the Government of Canada website and for the Office of Superintendency of Bankruptcy and find all of the filing information about who the creditors were and those claims that were against the company. Essentially, when a company can't meet its obligations, when it can't pay its bills, its creditors can petition the company into liquidation. Management then approaches a trustee. The trustee files for protection under CCAA, and that stops the creditors from essentially harassing the business, trying to foreclose, trying to recover any of the assets, and shutting down the business. From the point that the trustee approaches the government, they have 120 days to reorganize. The trustee is appointed by the court to supervise the reorganization. And one of the most interesting and contentious parts of this is that the managers who are in control of the business stay in control during this period. In fact, in order to maintain those people, sometimes they're even paid a bonus by the trustee so that they don't quit and go and find a job elsewhere. They need those people to manage the business during the period of rearrangement. During that period, the company needs to demonstrate that it's worth more alive than it is dead. And so it has to find a way to sell off some of its assets, perhaps get out of some of the leases that they have, to find a way to reorganize so that they can continue on in business. And at the end of that period, if they can't do that, the judge will order liquidation under the Bankruptcy and Insolvency Act. So they go through the first stage and then the second. They can skip right ahead to bankruptcy and insolvency, only if the management are convinced that there's no way that they can possibly save the business. If they do go into a condition of bankruptcy, there's going to be kind of a pecking order, an order in which the assets are going to be distributed. So once the company's liquidated, the cash is used to pay for environmental damage, pay for payroll deduct. In fact, you can see kind of a theme. A lot of these are government agencies who are going to be at the top of the list because the government makes the rules. So things like payroll taxes and deductions. Secured creditors will be paid, but only from the sale of secured assets. So if there are things with chattel mortgages, specific claims against a certain asset, those would be paid out next. The trustee has to be paid, so they would be paid their costs, any expenses that are incurred after the bankruptcy filing. Then wages, and this is a good one because typically or historically wages were at the very end of the list, and often employees didn't receive anything. Municipal taxes, claims for rent, creditor costs in the order in which they filed a claim. Any injury costs to employees, any unsecured creditors. Then we start to pay the shareholders. the first in the pecking order for shareholders, the preferred shareholders who have those preferred shares. And then finally, the common shareholders, the very end of that pecking order. So if you're a shareholder, perhaps you might get nothing from the business. You might get 5 or 10 cents on the dollar for the shares that you held. In liquidation, the unsecured creditors usually get nothing or close to nothing, and it makes them much more willing to participate in a reorganization. So perhaps they'll make accommodations like agreeing to transfer some of their claim into increased equity perhaps in the business. Perhaps one of the suppliers will agree to take over the business in order to save their claim. At some point, the groups of creditors will vote on a reorganization plan, and if the majority of the creditors agree and the judge approves, the company may return from that bankruptcy protection with lower debts, reduced interest charges, and some chance of success. So, I hate to finish up on a negative note, but that's pretty much where we are. If the company succeeds, if the company manages to repay its debts, it'll probably enter into a new round of debt financing in order to fund the next stage of growth. If they're unsuccessful, that's when we start to talk about the bankruptcy. In today's session, we saw how interest rates are determined. Essentially, we start off with the real risk-free rate. We discussed things like inflation premium, default risk premium. We looked at how the bond rating process works, and we'll discuss that more in class. We talked a little bit about liquidity premium and the maturity premium. We also finished up by talking a little bit about the downside, the true downside, financial insolvency and bankruptcy. That's it for today's session, and I look forward to talking to you in our next.